Hello friends, today I am going to begin Economic Survey 2020 Chapter 1 from Volume 2. So let us see Chapter 1. Now Chapter 1 talks about the state of economy. Now global economy in 2019-20, as per World Economic Outlook, global output was to grow at 2.9% in 2019, declining from 3.6% in 2018, making the global outputs slowest since 2009. The growth of advanced economies has declined to 1.7% in 2019. Larger group of OECD has also seen a decline, and WEO has projected declining growth of global output to rebound in 2020 with an uptake of 3.3%. Now, the economic survey has also explained the reasons for decline. Now, the reasons for decline are geographically broad-based decline in manufacturing and activity and trade has been observed throughout the world. Then stabilizing yet uncertain trade tensions between China and USA is another reason for the decline in global economy. Now, let us see the graphs. So you can see that in the world's in 2019, the growth in the world is 2.9% as against 3.6 in 2014. Whereas when you talk about India, now the Indian growth rate, when you talk about Indian growth rate, it is 5.6% as against 6.7%. Now growth of individual and BRIC countries. So in the red line you can see is India, and whereas the world is shown in green line. So you can see that India is constantly it was growing, then there was a decline. In 2019 is that it has declined, and again there is an uptick in 2020. Now, as with other major economies, India's GDP growth correlates with the global output. So, the deceleration of India's GDP growth since 2019 has been because of a decline in world output, as you had already seen in figure 2. Now, the WEO update for 2020 has projected the growth of Indian economy to increase to 5.8% in 2020, expecting India to contribute significantly to an eventual pickup in the growth of world output. That means here WEO expects India to grow, and not only India to grow but also to contribute towards the growth of world output. Now when you talk about GDP of India at nominal price, it was rupees 190.1 lakh crores. Besides a weakened global activity, the world inflation was muted in 2019. So world inflation was low in 2019, and there were two reasons. First reason was there was a decrease in consumer demand, and second reason was because of low energy prices, especially the price of oil was low. Now in India, when you talk about India, the inflation rose to 4.1% in April to December, as we can see in figure 3. You can see here India had a declining inflation up to 2018, and 2019 there is an uptick in the inflation, that is inflation has been increasing. Now let us see Indian economy in 2019-20. Now World Economic Outlook of October 2019 has estimated India's economy to be the 5th largest economy in the world, as measured using the GDP at current prices in US dollars. Now the size of Indian economy is estimated to be $2.9 trillion in 2019. So you must be knowing that we are almost 2.9 trillion, and we have a goal of $5 trillion. So now when we talk about Indian economy size wise, India is one of the largest economies. It is the 5th largest economy, ahead of France and even United Kingdom. So you can see for largest economy is United States, then second largest is China, third largest is Japan, fourth is Germany, and India is the 5th largest economy. When you talk about the US dollar trillion US dollars in trillions, United States is 21.4 trillion US dollars, whereas China is 14.1 trillion dollars. Japan is $5.2 trillion. Germany is $3.9 trillion, and India stands at $2.9 trillion. Now, top 10 economies are, sixth is United Kingdom with $2.7 trillion. Seventh is France with $2.7 trillion. Italy is with on eighth position with $2 trillion. Brazil is on ninth position with $1.8 trillion. And Korea, specifically the South Korea, is the 10th largest economy with $1.6 trillion. Now, India's dream of US 5 trillion economy has been challenged by less than expected growth of India's GDP. So, in 2019, the GDP of India has declined. Now, because of this decline, there has been a challenge to the India's dream of achieving $5 trillion economy. Yet, if you see India's record of growth and macroeconomic stability over the last 5 years, Indian economy is poised for a rebound towards $5 trillion. So we can see the target right now we are at $2.9 trillion, and the target to achieve by 2025 is $5 trillion. Now, gross value added and GDP growth. India's GDP grew at 4.8% in the first half of 2019-20. Now, this has been a muted growth in India. Now, we must be wondering why there was a low growth. So, if you have studied the GDP chapter, you must be knowing that GDP can be calculated from supply side as well as from demand side. Now, supply side is gross value added. Now, when you talk about the gross value added contributed by all sectors except agriculture and allied activities and public administration, defense and other services has been low. So, the contribution of other sectors has been quite low. Only agriculture and allied activities had shown some relief. Now, when we talk about the demand side also there was low growth because of following reasons. Now, there was a decline in the real fixed investment in the first half of 2019-20. Now, this decline in the real fixed investment was because of the low growth of real consumption. So consumption was not growing, that is why the investment also did not grow. As a result, the demand was sluggish. Now, growth of real consumption did pick up in Q2 due to government final consumption expenditure. So real consumption has increased a bit, but it was not because of the it was not because of the consumers. Basically, government contributed a lot towards the increase in Q2. Now, when we talk about private final consumption expenditure, it also picked up in the second quarter, but not too much. Now, when we talk about exports, the net exports have become less negative. Usually in India, we often find that imports are more than exports, and there is a huge gap between exports and imports. So it is a huge deficit there. However, in this quarter, we have seen in Q2, the difference between exports and imports has been low. As a result, the net export has been less negative in real terms. Now, lower GDP and softer crude oil may be a result of contraction of imports. May be causing the contraction of imports. That means imports might be low, or the payment of imports might be low because of lower GDP of the world, as well as the lower prices of oil. Now, real growth in GDP in percentage. When we talk about GDP, the growth in 2019 first quarter has been 5% GDP growth rate, whereas in second quarter it had been 4.5%. When we talk about total consumption in first quarter was low, only 4.1%. It did pick up in the second quarter by 6.9%. Now, this aggregate of 6.9% has been contributed because the government consumption grew up to 15.6% in Q2. Although there was some upsurge in private consumption also, because it grew from 3.1% of Q1 to 5.1% in Q2. Now fixed investment has been low. Now you can see in 2017-18 and 18-19, the fixed investment have been 9.3% and 10%, whereas in 2019-20 investment had been a drag, where you can see in quarter 1 it was only 4% and quarter 2 it was merely 1%. Now when we talk about exports of goods and services, exports of goods and services were in quarter 1 were 5.7%, whereas in quarter 2 they have declined to minus 0.4%. Whereas imports in quarter 1 have been 4.2%, whereas quarter 2 they have declined to minus 6.9%. Thereby the difference has been low. Now despite deceleration in GDP growth for the 6th consecutive quarter, the stock market was upbeat about the growth prospects of India. Now, this reflects the growing perception of India becoming an attractive destination for investment. Now, you can see that world economy is also growing sluggishly. Now, when world economy is growing at a rate of 3.3%, India's growth story is still better when you compare with other countries. Now, because of this, the people have been, the foreign investors are showing interest in Indian markets, and India is becoming an attractive destination for investment. So when we talk about FDI and FPI in first 8 months, the net foreign domestic investment were $24.4 billion, whereas portfolio investment was $12.6 billion respectively. Now you must be knowing that portfolio investment is investment in the stock market. So that was $12.6 billion, whereas the FDI investment, that is investment in assets and so on, was $24.4 billion. Now, we in the economic survey, there has been quarterly analysis for past many quarters. They had been doing this analysis for almost 26 to 30 quarters. Now, after the quarterly analysis, it appears that the length of business cycle in India is 13 quarters. Now, because the length of business cycle is 13 quarters, so there the slowdown that we experienced in 2019 seems cyclical because it was the 13th quarter, and thus a resurgence of growth is expected in the second half of 2019-20, and that uptick will continue in 2020-2021. Now when we talk about inflation in the first half of 2019-20, the headline CPI was 3.3%. Now, headline inflation in December, however, increased to 7.35%. Now, this was because of supply side factors or constraints. That is, there was a food price hike. Now, food price had increased because of unseasonal rainfall and flood-like situation. Now, WPI, that is wholesale prices index, it declined from 3.2% in April 2019 to 2.6% in December 2019. Now this reduce in the WPI has been because of weak demand. Now core inflation. So core inflation is defined as headline CPI minus the inflation of food and fuel. So the core inflation was 4.3% in quarter 2 of 2019-20. Now let us see some employment scenario. Now formal versus informal. So there has been a lot of talk about India being an informal economy, where a lot of people in India are working in informal sector. So all those who do not know the difference between formal sector and informal sector, see, formal sector is a sector where people are getting a regular wage or they are salaried employees, whereas the informal sector means a sector where people work as a casual labor or they are self-employed. The unorganized sector comes under informal sector. So earlier the employment status was studied by NSSO surveys of employment unemployment survey, whereas now they are being studied by periodic labor force survey. So although because of a difference in methodology, the strict comparison between the periodic labor force survey and NSSO employment unemployment survey is not possible, yet a limited comparison had been done in the economic survey to highlight the shift towards increasing employability in the formal sector jobs. That means people are slowly moving from informal sector to formal sector, and this is known as formalization of economy. That means when people leave their informal jobs and they convert into regular employees, that is called formalization of economy. Now this is shown by data. So for example, there has been increase in the share of formal employment from 17.9% in 2011-12 to 22.8% in 2017-18. So when you talk about the formal employment, merely 17.9% people were formally or regularly wage employees in 2011-12. But in 2017-18, 22.8% of people were regular wage or salaried employees. Now this change of 5% or this increase in 5% in the formal sector has been a result of a decline in the share of casual workers. So 5% decline in casual worker, those 5% casual worker have come here in the regular sector. So this reflects the formalization of economy. Now another thing that we can see from this survey is the proportion of women in regular wage or salaried employee has increased by 8% points. So when you talk about the formal employees, so let us say there are 100 employees in economy. So out of these 100, 23 people are working as a salaried employee. Now out of these 23% people, in these 23% people, 13% of 23% people were women in 2011-12, whereas now 21% of the formal employee are women now. So the proportion of women is slowly increasing in the salaried employees. Now we have seen that in rural sector, the laborers have shifted from agriculture to industrial or service activity, which is a good trend because it will reduce the disguised employment also. So rural sector labor is shifting from agriculture to industry, whereas in urban sector the people are shifting from self-employment to a salaried job. So you can see this with the help of graph also. Self-employed in 2011-12 were 52.2%. In 17-18 also they were 52.2%. Whereas when you talk about regular wage people, 17.9% people were regular wage in 2011-12, whereas irregular wage people are 22.8% in 2017-18. So this shift has come from casual labor. There is no change in the self-employed status, but the shift has come from casual labor, which is a good trend. Now when you talk about fiscal situation of the country, in 2019-20 the central's fiscal deficit was budgeted to be 7.04 lakh crore 7.04 lakh crore rupees. That was 3.3% of GDP. However, in the first 8 months of 2019-20, the fiscal deficit was 114.8% of the budgeted levels. That means the government has pressed its limit of the fiscal, government has increased the fiscal deficit. Now when you talk about from GST revenue, now GST revenue from April to December, the gross GST revenue has crossed 1 lakh crore 5 times. That means almost 5 lakh crore has been the GST revenue from April to December. In December 2019 itself, the GST revenue was 1.03 lakh crore rupees. Now centre's budgeted expenditure grew at 12.8% in April to November over the previous period. So when you compare the expenditure of government in 2018, when you compare it with 2019, there has been an increase of 12.8%. Now capital expenditure also grew 3 times vis-a-vis 2018-19. So you can see the fiscal deficit. In 2009-10 fiscal deficit was 5.4%. In 2018-19 it was 3.4%. In 2019-20 it was 3.3% was budgeted. Then April to November 2018 it was 3.8%, whereas April to November 2019 it was also 3.8%. Now monetary policy. Now, monetary policy, RBI has been following a wide money policy. That means it has been reducing the rates. So, RBI has reduced the policy repo rate by 135 basis points since February 2019. Now, the median of 1 year marginal cost of lending rate MCLR reduced only by 49 basis points. So, you can see that usually the RBI reduces the repo rate expecting the banks to translate it to the consumers or their customers. However, this has not been happening. So, although RBI reduced it by 135 basis points, the banks had reduced the MCLR, marginal cost of lending, had been reduced only by 49 basis point between February to November 2019. So, the transmission of this reduction has been about only one third of the rate cut by RBI. Now, the credit growth. Now, credit is started accelerating in half two of 2018. So, since 2018, the loan that was being given by the banks started reducing, and this trend of reduced loan continued in half one of 2019. Now, this was because of risk aversion by banks. So, banks are not lending much because they are already having lot of non-performing assets, and banks are facing a lot of pressure. That is why banks are aversing risk, or banks are not taking risk. So there has been a slump in the credit given by bank. Now the IBC process, that is insolvency and bankruptcy code process, contributed to reducing the NPAs from 11.2% of gross advance in March 2018 to 9.3% in September 2019. So, although IBC process is reducing the NPAs of the bank, however, this process is still slow. The speed is not very fast. Now, since the process is slow, banks are not still not in a risk taking mode. They are still in the mode of risk aversion, and that is why the credit has not been growing. Now, when you talk about the external sector, in October and November 2019, major commodity groups have shown a positive growth in exports, while imports of the same has contracted. That means most of the see, when you talk about the external sector, so external trading happens in commodities and services. So when you talk about commodity, most of the commodities the export has grown much, whereas the import has contracted. So there is a positive growth in exports. Now the trade balance has improved in 2019-20 because of this. Similarly, now this contraction in imports have come due to decline in oil prices. So if the oil prices are more, the imports become costlier for us. Now the oil prices are less. As a result, the imports have contracted a bit. So that has improved our trade balance in 2019-20. Now trade balance of services also was positive in 2019-20. So this combined trade balance, that is current account deficit, has improved to 1.5% in half one of 2019-20 due to significant reduction in trade deficit. So slowly trade deficit is reducing because of improvement in trade balance as well as improvement in the service balance of service. That is why CAD has improved to 1.5% in half one. Now balance of payment situation of country also has improved. Now exchange reserve on 10th January 2020 stood out to be 461.2 billion US dollars. Now sectoral development, share of agriculture and allied activities and industrial activities has declined in the total gross value added from 2009 to 14 to 2014-19 due to relatively higher growth of a tertiary sector. So India was initially a agricultural economy. When you talk about India's growth story, so India was a agricultural economy. So at that time, agriculture, forestry and fishing used to contribute a lot to the gross value added. Now this share of agriculture is slowly declining and the share of tertiary sector has been increasing. So this is a normal process of development of any country. So same is happening in India also. Now we can see the agriculture, forestry and fishing in the first half of 2019-20 contributed to 13.9% of GDP, whereas the industry, that is the secondary sector, so secondary sector overall contributed to 28.3% of GDP. Now out of which mining and quarrying contributed to 2.1%, manufacturing has contributed to 15.4%, electricity, gas, water and other utility service 2.9%, and construction 8%. Whereas when you talk about services contributed to 57.8% of GDP. Now in services, trade, hotel, transport, storage, communication, broadcasting contributed 18.1%, whereas financial, real estate and professional services had contributed the highest, that is 24.5%. Now public administration, defense and other services contributed 15.2%. Now first advanced estimates of 2019-20, the real GDP during 2019-20 is 5%. Now nominal GDP is estimated at rupees 204.4 lakh crore in 2019-20. And the fixed investment as a result of GDP at current price. Fixed investment as a percentage of GDP has been 28.1%. Now some key indicators. Nifty India Consumption Index has picked up in October 2019. Now BSE Sensex increased by 7%. Net FDI has been $24.4 billion. Then lagged effect of previous cuts in repo rate are showing as a build-up of demand pressure with growth in inflation. That means previously in many quarters when RBI had been reducing the repo rate. Now immediately see in macroeconomics the changes are not immediate. They take some time to show up. So those changes, that effect of reduction in repo rate is showing now, and that is why demand is increasing, which is resulting in inflation. Now trade for farmers also has been improving. Now this will result in better growth in the rural areas. Industrial activity is rebounding and it is showing a sign of pickup. Now this is because IIP, that is industrial IIP has registered growth of 1.8% in November 2019. So the industries have been increasing and they are showing a growth of 1.8%. Now PMI manufacturing has registered a steady improvement. Growth of merchandise exports also has also improved. That means growth of the goods has improved. Growth of goods export has improved. Forex reserve has been very high, that is 461.2 billion on 10th January 2020, and gross GST has surpassed rupees 1 lakh crore 5 times. Now growth of GVA at constant prices. When you talk about constant GDP at constant price, GVA at basic price is minus 1.7%. In overall there has been a change of minus 1.7% only. Then industry is showing minus 4.4%. Services also has been declining. So we can see that GDP overall is declining in 2019-20 as you compare it from 2018-19. So when you talk about 2019-20, in the first actual estimate, GVA at basic price has been 4.9%. Whereas industry grew by 2.5%, agriculture by 2.8%, services by 6.9%, and GDP at market price has been 5%. Now when you talk about 2018-19, the growth had been 6.8%. So comparatively from 2018-19 to 2019-20, there has been a decline in GDP by 1.8%. Now key indicators, GDP and related indicators. GDP at current market price in 2019-20 is 204.4 billion. Now GDP at constant price, market price is 147.8 billion. Growth rate is 5%. GVA at current prices is 185 billion. GBA at constant prices is 135.4 billion. Then gross savings has reduced, growth rate is 4.9% in 2019-20. Gross capital formation not available, data is not available for 2018-19 as well as for 2019-20. Now per capita national income is 1,35,050 rupees, whereas in 2018-19 it was 1,26,406 rupees. Now food grains, when you talk about food grain production in million tons, index of industrial production IIP, food grains has been 140.6 million tons in 2019-20, whereas in 2018-19 it was 285 million tons. So there also the decline is registered. When you talk about index of industrial production, IIP was 3.8% in 2018-19, whereas in 2019-20 it was only 0.6%. Now electricity generation has also fallen down from 3.5% to 0.3%. WPI inflation, wholesale price index inflation, was 4.3% in 2018-19. It is 1.5% in 2019-20. CPI combined inflation average is 4.1%. Now merchandise export growth rate was minus 2% in US dollars, whereas import was minus 8.9%. So cumulative effect has been higher. And current account balance, when you talk about as a percentage of GDP, in 2018-19 it was minus 2.1%, whereas now it is 1.5%. Foreign exchange reserve were 412.9 billion US dollars in 2018-19. Now we have seen it as 457.5 billion dollars in 2019-20. Exchange rate, again exchange India currency is depreciating, so exchange rate is 70.4 rupee. $1 is worth 70.4 rupees. Now the recent growth deceleration is a drag of the financial sector on real sector. So in 2018-19 survey, the survey had talked about the virtuous cycle of growth. Now this virtuous cycle of growth shows how the fixed investment can increase the growth in GDP. See what investment does. Investment results in higher fixed investment causes a growth in GDP. Now this growth in GDP causes a increase in consumption. See, economic consumption increases investment, investment increases economic growth, and growth again increases consumption. So this is called virtuous cycle of growth. Now if this cycle, so higher consumption causes more investment causes more fixed investment causes more economic growth, and more economic growth again increases the consumption. So this is a cyclic process. Now suppose if the investment reduces, so what will happen when the investment is slowing down? So the economic growth will also slow down. Now slowdown in economic growth will cause reduced consumption, and reduced consumption will further make a decline in investment, thereby causing a opposite cycle. The cycle will run in an opposite manner. So when the virtuous cycle rotates slowly, the declining rates of investment decelerate GDP growth with a lag as well as consumption. So what happens is, if there is a decline in investment, that is fixed investment has reduced. Now as soon as the fixed investment reduces, it will not show immediate impact. After few years there will be a slowdown in economic growth, and after few years of slowdown of economic growth, consumption will fall down. Now fall down in consumption will further reduce the investments, and this will cause a total slowdown in the economy. So that is what is being experienced in India. So in India, the lag of between the rate of fixed investment and its impact on GDP is seen to be 3-4 years, while that of GDP and consumption is 1 to 2 years. So if you want to calculate the investment and GDP, and if you want to see the correlation between investment, GDP and consumption of the same year, this cycle will not hold true. So if you want to study this macroeconomic data in totality, you will have to see few years back. So because in India, the lag rate between reduced investment will show their impact on GDP in 3-4 years, and further the impact of slowdown of GDP will be shown on consumption in another 1-2 years. So the deceleration in the growth rate since 2017-18, we are seeing a growth rate has been declining. Now this is because of the slowdown in the virtuous cycle of growth. Now this happened because stagnation in the private corporate investment at about 11.5% of GDP happened in 2011-12 to 2017-18, and this has a critical role in explaining the slowing cycle of growth and deceleration of GDP and consumption. So what happened was, see, every economy goes through a cycle of boom in credit and then a decline in credit. So initially when there was boom in credit, the growth was happening, investment was increasing. Now increased investment caused high GDP, and high GDP resulted in more consumption. Now slowly when the boom started, when the banks started having a high NPA, they became risk averse, and when they became risk averse, they reduced their lending. Now reduction in lending cost slowdown in GDP, and this slowdown in GDP further caused a slowdown in consumption. So that is what is being experienced in economy now. So GDP has the stagnation in private corporate investment. Fixed investment in private corporates is not increasing. Since investment in private corporates is not increasing, it is not causing a increase in GDP, and since GDP is not increasing, the consumption is also falling down. So that is what is happening in country at present. Now outlook. Now IMF and World Bank in January 2020 had projected India's real GDP to grow at 5.8% in 2020-21. Now with a view to make assessment of likely growth, downside and upside risk to an expected acceleration of GDP should be calculated, and these are discussed as follows. Now downside risk. Downside risk means what can make the GDP to fall down. Now GDP can reduce because of global tensions and constraints on export perform, which can cause a constraint on export performance of the country. Now because of see, everywhere we can see in the world, protectionist tendencies are on rise. As a result, the export of India may suffer. So that is one risk. Second risk is escalation of US-Iran geopolitical tension. So we have already seen in the beginning of January, there has been a lot of US-Iran geopolitical tensions. Now if they escalate in the year, now this may cause an increase in crude oil prices. Now since the crude oil price will increase, it will have two impacts. One, it will depreciate the rupee value, and secondly the imports will start expanding again. Now this will weaken the FPI inflow into India. Then there can be growth in advanced country has weakened, and inflation is also low in advanced countries. So advanced countries, if they are not growing, then overall growth of the world economy may also suffer. Then a slow progress in IBC code is leading to a risk aversion by banks. This is one downside risk again. If the banks are not very enthusiastic about lending, then the virtuous cycle of growth will not kick start, which will again cause a decline in GDP in India. Then investment in public sector may increase after the announcement of National Infrastructure Pipeline (NIP) of projects worth rupees 102 lakh crore. Now if there is extra investment in by the public sector, it may certainly expand the fiscal deficit. Now since the fiscal deficit will expand, the bond yield will become high. So the people may start investing in the government bonds instead of investing in private investment. Not people when we talk about bank and financial institutions. So for banks and financial institutions, an investment in bond yield will be more will be better option as compared to private investment. So bond yields may crowd out the private investment. Then non-rising GDP rate may further deteriorate the current account deficit and depreciate money and make the virtuous cycle difficult to realize. So if the domestic saving rate are not increasing, then it will deteriorate the current account deficit, then money depreciation will happen, and again the GDP will not grow. Now upside risk are things that may increase GDP more than expected. So what can happen in upside risk is tentative signs that big business activity and global trade are bottoming out, which may positively impact India's export. So there are signs that manufacturing activity throughout the world is picking up, and if the manufacturing activity picks up, India's export will also increase. Then government's thrust on affordable housing is boosting the real estate sector, and real boost of real estate sector will have lot of multiple cascading effect on the economy. So it may improve the economic situation of the country. Then global sentiment again continues to favor India, as we had already seen. People are despite a slowdown in for last 6 quarters, FDI and FPI are continuously increasing in India. So that is another thing. India is still a attractive market. So FDI inflow may increase in the country. That will improve GDP for country. Then boost to make in India may expand the domestic manufacturing. Ease of doing business and increase unification of market along with labor reforms may reduce the business cost, which will further make Indian market competitive and attractive for the firms to make in India. Then reduction in corporate tax to 15% for new manufacturing firms may surge investments in the in new areas. Then merger of public sector banks may increase the financial strength of the merged banks. It may lower the risk aversion and it may result in lower lending rates. Now projection of based on these survey of these upside and downside risk, projection of GDP growth in 2020-21. So it appears that the risk should upside risk should prevail, particularly because we have a strong government mandate and which can deliver the reforms, positive reforms which are expected. So India's growth rate is expected to grow in the range of 6% to 6.5% in 2020-2021. Now summary of the chapter. India's economic performance in 2019-20. India's GDP growth moderated to 4.8% in first half of 2019-20 because of weak environment for global manufacturing, trade and demand. Now the real consumption growth has recovered in quarter 2 in 2019-20 because of significant growth in government final consumption. Growth of agriculture and allied activities and public administration, defense and other services in 2019-20's first half was higher than in second half of 2018-19. So we have seen that agriculture and allied activities and public administration, defense and other services have improved. Now India's external sector had gained stability in first half of 2019-20. So this can be shown because of following points. See, first thing is current account deficit has become only 1.5% of GDP in first half of 2019-20. If you compare in 2018-19, current account deficit was 2.1%. So CAD is declining, which is a positive sign. Then FDI has been quite high in India. FPI has also rebounded in India. So there has been rebounding of portfolio inflows. Then accretion of foreign exchange reserve. We had already seen that foreign exchange reserve are almost 461 billion US dollars in 2000 on 10th January 2020. Then sharper contraction of import as compared to that of export in first half of 2019-20 because of easing of crude prices. That means imports have declined as compared to the exports. Exports are not as export have also declined, but the decline of import is higher as compared to exports. Now, headline inflation is expected to decline by year end. Now, increase in headline inflation was 3.3% in first half of 2019-20. However, it became 7.35% in December, and this was because of increase in food inflation. Then there has been rise in CPI core and WPI in December 2019-20. Now, this also suggests the building of demand pressure. So, CPI and WPI are also indicators of demand. So, because of rise in core CPI inflation and WPI in December 2019-20 is suggesting that people are increasing the demand. Then, deceleration in GDP growth rate is because of the slowing down of the cycle of growth, because see, financial sector is acting as a drag on the real sector. That is, investment is reduced. Reduced investment is reducing the growth is further reducing the consumption, and consumption is causing to a decline in investment further. So the reforms that were undertaken during 2019-20 to boost investment and consumption and exports were: first, speeding up of the insolvency resolution process under the Insolvency and Bankruptcy Code. We had already seen this has caused a decline in NPAs. Then second thing, easing of credit, particularly of the stressed real estate and NBFC sector. Then third thing is announcing of National Infrastructure Pipeline 2019-20. We have also seen this, that government has announced almost 101 lakh crore investment in National Infrastructure Pipeline in national projects. Then survey expects an uptick of GDP growth in second half of 2019-20. So the growth of GDP in 2019-20 should be 5% based on CSO's first advance estimates. Then expeditious delivery on reforms for enabling the economy to strongly rebound in 2020-21. So government is expected to deliver reforms that will enable the economy to strongly rebound in 2020-2021. So this chapter contains all the facts and figures you need for your prelims and mains examination. Please read the PDF, as well as PDF is already shared on the channel at Telegram, and please watch the video so that you remember these facts and figures. This is very important chapter. So I will continue other chapters, especially now I will take the volume 1 of the economic survey, because whatever the facts and figures and data you had to study in first chapter, that I have already given. Second, third, fourth chapter I will give a small summary in another class, and maybe today or tomorrow I will post the chapter 1 and volume 1 of economic survey, and then I will continue with again with the volume 2. So please keep watching the playlist and keep following me on Telegram as well as on YouTube for more content. Thanks a lot. If you like the video, please click the subscribe button and press the notification bell, and please share the video, and please comment whatever you need extra. Please tell me any feedback if you have in the comment section.